This morning on the Ag Issues program, a pleasure as always to bring on to the program Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine, thanks.
Well, I appreciate it as always coming on the program. And Roger, for you and many producers, this is something that you've been waiting for in association with the One Big Beautiful Bill Act, the final rules implementing the payment limitations and rule changes of OBBBA in regards to the FSA rules that take place. And I don't think it's can mention this enough that it was something that was well waited for.
Yeah, this is an absolute monumental shift for ag operations. And I was part of a group of, I was the only attorney in the group, but others that were CPAs that deal with farm clients. We've been pushing for these changes for a number of years and been working along with National Office of FSA to get these rules written the way that we needed them to be written. And now we got the legislation in the OBBBA, the One Big Beautiful Bill Act, and now we have the implementation of the rules, with one caution that I'll talk about in just a moment. But, you know, Greg, I think the big takeaway is that USDA has officially modernized the payment limit mechanics for farm programs, and it takes effect immediately for the 2026 program year. And what I mean by that is, historically, if you farmed as a limited liability company or an S corporation, you were structurally penalized by being capped at a single entity level payment limit. And that was the case no matter how many family members were active in the business. Now that changes. That changed under the OBBBA. And now the rule which implements that establishes parity, I would say, by creating a new category. It's known as a qualified pass-through entity, or a QPTE, as if we needed another acronym in FSA programs. It's acronym soup. But what that means is, going forward, LLCs and S-Corps can finally stack payment limits based on the number of active owners, just like general partnerships have done for decades. So it opens the door for us that do estate planning and transition planning and structural planning for farming operations. It opens the door for us and gives us more options where we don't have to maybe layer our structuring so that we're maximizing payment limits by having a general partnership operate the farm and then get liability protection for the individual owners by creating substructures to create that. We don't have to do that anymore.
So this really clarifies for the qualified pass-through entity as to who is eligible for this, or I guess give it a lot more clarity in this case.
Yeah. We've got four categories for a QPTE. That's the qualified pass-through entity. And the first one would be any partnership under Subchapter K of the Internal Revenue Code that is taxed as a separate entity. So it's a separate tax entity. And secondly, you've got an S corporation. I mentioned those just a moment ago. Third one would be any LLC that has not elected to be taxed as a C corporation. And then, of course, fourth would be your traditional joint ventures and general partnerships. Now, this is the point I would add on this. It's a little bit of a caution here. And this is a problem. Often we've got some good friends, I tell you, in the national office under the new administration that allow us to review and comment on language before it becomes finalized. This moves so fast, and we were all traveling and speaking and so forth. But the regulatory text here suggests that limited partnerships and LLPs should qualify because they're taxed under Subchapter K. However, the USDA's preamble discussion leans almost entirely on LLCs and S corporations. Now, here's the caution I would have. If you're currently operating under a limited partnership variation, then you absolutely need to double check your status with your local FSA office before assuming you can stack those limits, because my guess is they're not going to understand that. That's unfortunate. Had we had a chance to see that, we would have gotten that language in the preamble for them. Yeah, everything should qualify that's taxed under Subchapter K, but I fear that local offices are going to go off that preamble language, and you're going to have some explaining to do. So that's an point of education I'm going to have to focus on in the coming weeks and months.
And so much of it is how complex your ownership structure is.
It is, yeah. And what this does is it actually will decrease the level of complexity needed to maximize payment limits, and that's a good thing.
All right, let's move on here to another part of this, and specifically some of the numbers. You know, when we look at the actual dollar limits for the programs, say for like ARC and PLC, so how does this stacking rule translate on a real-world family farm?
Yeah, to see the real impact on this, I think we have to look at the actual index program numbers. Now, the old statutory text references $125,000. There's a separate rule, final rule from January of this year that indexed those limits for inflation. So the adjusted, now the OBBBA took it to $150,000, but under the indexed amount for inflation, the adjusted ARC PLC limit is $160,000 for 2025. And it stands tentatively at $164,000 per person for 2026. So under the old rules, let's take a look at how this works. And this is where, you know, Greg, I was listening to the ag news you were playing before the 6 o'clock news came on, and there was that hearing that the ag secretary was at, and you had, I don't know who the congresswoman was, but she wouldn't let the ag secretary talk. And she's talking about financial issues in ag. My thought to myself was, are you kidding me? Do you realize what's coming this fall? Listen to this. Under the new rule, so let's say I've got a family LLC with 4 active members. You were capped, and without OBBBA, you would have been capped at $125,000. So OBBBA pushes that to $150,000, indexed it, and we're now sitting at $164,000 per person. So under the new rule now, when you change the payment limits, you multiply that $164,000 base by the 4 active owners. That gets you to $656,000. So if that farm generated $700,000 in program payments, say ARC PLC that they were entitled to, the old rule forced them to leave over $500,000 on the table. You're not going to get that. Now they capture $656,000. They get all of it. That is a massive, massive financial swing for multi-owner family operations. That's huge.
All right, before we go to a break, I wanted to ask one more thing. You know, looking at the stack limits, to be able to get those, each owner still has to meet the requirement of being, as you know, actively engaged in farming, which we've heard that term many times before. But from what I understand, that the final rule fixes a historical trap regarding family members who draw salary from the farm. So can you explain that?
Yeah, and there's a lead up on that. Let me explain that. We've got strict look-through provisions when we're talking about entities. So if I've got a nested or multi-tiered operation, the FSA is going to bypass the embedded pass-through entity and look through up to 4 levels of ownership to count the actual individuals or qualifying entities who are generating the limits. You don't get separate limits for internal corporate layers. So that's one thing we have to be aware of. But to get these stacked limits, each owner still has to meet the requirement of being actively engaged in farming. And this is a crucial fix because, as you mentioned, there's a historical trap here regarding family members who drew a salary from the farm. They have fixed that now. So to be actively engaged, a member has to contribute capital, equipment, or land plus personal labor or active personal management, and those contributions have to be at risk. In the vernacular, that's the right-hand contributions, the left-hand contributions. So historically, if an owner or family member received a standard salary or guaranteed payment from the entity, then FSA completely disregarded their labor or management when determining if they were actively engaged. It was a structural penalty on basic corporate payroll practices. Now, effective for 2026, I'm talking crop years here, compensated labor and management count toward the actively engaged determination for all of your qualified pass-through entities. So, for example, let's take a family S corporation where a daughter handles the day-to-day management. She gets a $90,000 salary. Under the old rules, her management was ignored because it was compensated, meaning she didn't add a payment limit. Now her paid management counts, so she qualifies as an active owner. She brings a full separate payment limit, another $164,000 to the operation. That's big.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is our guest, looking at the USDA final rule implements on significant payment limits and eligibility changes that have been taking place. So, Roger, let's shift to the $900,000 average AGI, or adjusted gross income. OBBBA added a major relief valve for producers who hit that cap but generate most of their livelihood from the land. So how does that exception work?
Well, a couple of things here, Greg. First, the rule clarifies that pass-through entities will no longer certify AGI compliance at the entity level. It's pushed entirely to the individual member level. And then secondly, the new law now completely waives the 900,000 AGI cap for specific disaster and conservation programs if at least 75% of the producer's average AGI comes from farming, ranching, or silviculture. So that applies to what USDA calls accepted, that's EXC, programs. Things like I would put in that livestock forage disaster program, livestock indemnity program, the ELAP, the NAP, NRCS conservation programs like EQIP and CRP. And there's a massive distinction here that producers have to understand. The standard $900,000 cap is based on adjusted gross income. That's net income after deductions. But the 75% exception is based on gross income. That's total revenue before expenses. Because production ag generates high gross revenues relative to net returns, a legitimate farmer who has high AGI from unique tax year or outside investments can often easily clear that 75% gross farm income threshold and save their disaster payments. But keep in mind, the waiver does not apply to traditional commodity programs like ARC and PLC. Those are the major points with respect to that 900,000 cap.
You know, the rule also expanded what counts as deemed as farm income to help producers meet that 75% threshold. Is that correct?
Exactly. The USDA, and this is a big deal, and I've been working on this for a number of years with some of my other colleagues. The USDA expanded the definition in two, what I would call highly practical ways. First, they explicitly included direct-to-consumer sales and agritourism, things like farm stands and UPIC fields and CSAs and online sales of farm-produced goods. That was in the OBBBA. That's in the statute. And secondly, they completely removed the old restrictive 66.66 or the two-thirds rule for equipment sales. This is a big deal because under the Tax Cuts and Jobs Act, which started in 2018, you can't do a like-kind exchange on machinery. That's just limited to real estate. Now, you still do it. Farmers are going to trade combines and tractors. We know that. The point here is it's not reported through the Schedule F. It goes through Form 4797. So it wasn't getting in this AGI computation. FSA kept saying, well, that's not on Schedule F. That's not farm income. Well, that's a bunch of baloney. And Congress had to fix that. They did. Now, those equipment sales didn't count as farm income unless you already met a high baseline of farm revenue. Now, the point here is selling used equipment or trading it in toward new machinery explicitly counts as farm gross income. Again, that's in the underlying statute. That was in the One Big Beautiful Bill Act. They carried that out in the rule. That is a huge, huge issue because there are some years where all of the farmer's income is going to come from these trades of machinery and equipment. And previously, FSA would say, well, you didn't have any farm income. You're not eligible for higher payment limits, and you don't meet the test. Now they do.
Roger, as well, as they listen to this and kind of, digest all this as well, what are some of the critical dates and immediate steps farmers need to take right now to make 100% sure that they're compliant?
Yeah, this is the key point here to watch out for these deadlines. These changes apply strictly to the 2026 program year and then going forward. They are not retroactive. So the ultimate date on the calendar is September 15, 2026. That is the hard operational, I'd call it a snapshot date. So your entity structure, your ownership percentages, your member contributions on that exact date will dictate your farm's total limits and attributions for the year. Now, you have to, what I would advise people to do, all the farmers that are listening, is sit down with your CPA, with your legal counsel immediately and make sure they're familiar with this. I covered this extensively at our seminar in West Virginia last week. That was kind of the beauty of this. We got the rules on Monday. I had stuff out ready to go Tuesday. And then we had it incorporated into the seminar for the CPAs and attorneys who were coming from all across the country. We were on East Coast time, but we had online participants from California that they were starting a technical seminar at 5 a.m. We'll see how that went for them. But we spent quite a bit of time on this. So what I would say is get with your CPA, your attorney, make sure they're familiar with the rules first, but formally document your owner contributions. That'd be the first point here. So you need to audit your 2022 through 2024 gross income streams if you're near the AGI threshold, if you're near that 900,000 threshold, and get your updated farm operating plans filed with the FSA well ahead of that September 15 deadline. If you have larger pass-through structures for your operation with 6 or more members, those plans face an automatic 60-day state-level review. So that's going to make early filing for those operations, those more technically structured operations, absolutely vital. That's the key point. If there's one take-home out of all of this, for those that are listening that this applies to, that's the key point.
And everything we talked about, Roger, you have posted this on your blog?
I have posted what I call the Reader's Digest version of this on my blog. That was up yesterday. This is really technical stuff. I've tried to boil that down and get a version for farmers and ranchers that they can easily pinpoint what the take-homes are out of this. And I tried to keep it under 2,000 words. That's always my goal on the blog. So that's on my blog. I sent that yesterday to K-State, so they'll have it up on Ag Manager later today. I also sent it to RFD TV. It'll be up on the version of my blog that RFD TV carries, and I'll probably cover it tomorrow on RFD TV tomorrow morning. And I am working on the more detailed professional version for CPAs and attorneys that's going to go on my Substack, and that'll be done later this week.
Okay.
That's for my subscribers there.
All right. Sounds good. Roger, as always, I appreciate it. Thank you very much.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law. He has been our guest on the Ag Issues program this morning here on 580 WIBW.